Welcome to this Asset TV Real Assets Masterclass. Joining us are Ed Coyne, Senior Managing Partner at Sprott, Jodie Gunzberg, Managing Partner at InFi Strategies, and Don Marleau, Metals and Mining Managing Director at S&P Global Ratings. Everyone, thank you so much for being here. We're going to dive right in. Let's start with you, Ed. Can you please start by telling us a little bit about Sprott?
Sure. Sprott's a unique firm. We're a global leader in precious metals and critical materials. We have over 4 decades of experience in the space. We're one of the largest firms out there that focuses just in the metals markets and the materials markets. We have over $40 billion in assets under management. We're also a publicly traded company. We trade on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. And what's unique about our firm is we really offer multiple solutions. So whether you're looking at the physical market, we own physical gold, physical silver, platinum, palladium, even physical uranium and copper. We also have a suite of ETFs and mutual funds that give you exposure to the underlying mining stocks themselves. And then last, but certainly not least, we do private lending, where we raise capital and we loan it to mining companies predominantly for operating leverage purposes. So for our investors that are looking at this space, we have multiple ways to invest in it, whether it's a physical or equity or debt market. And then we also have multiple ways to do it from a vehicle standpoint, whether it's ETFs, physical trust, direct lending, and so forth. So we're a unique firm. We cover a lot of the waterfront and focus on precious metals and critical materials.
Now, setting the scene, I'm going to turn to you, Don. How would you describe the current environment for real assets?
Hi, Aaron. We've been highlighting the scarcity of hard assets like gold mines, steel mills, and critical minerals for several years. Prices for most of these metals responded as expected to inflation, which means that prices are about 20% higher than before the last bout of inflation. Now, we look at credit risk in metals and mining, which is basically debt load backed by hard assets. And in that respect, credit quality has been improving for most of the last decade. And that is backed by a long track record of more steady prices for most metals and more disciplined capital spending on new assets.
Jodie, I'm going to turn to you now. Why should advisors consider adding real assets if they don't already exist in their portfolios?
Yeah, typically advisors would add real assets because of diversification and inflation protection benefits, even the hedge against the US dollar. And there's a lot of choices of real assets that investors can use, whether that's commodities, real estate, infrastructure, sometimes tips are considered, now even Bitcoin. And if anything, beyond the diversification and inflation protection investment case, they're great talking points. And a lot of the advisors' practices are relationship driven. And everybody knows what gold is. They know what corn is. They know what buildings are. They know what infrastructure is. So it's an easy conversation point and a way to connect with investors who don't understand the benefits of real assets.
Right, as opposed to some sort of municipal insurance vehicle that it's a little less tangible. But Ed, let's turn to you. So investors looking for commodities for the first time, let's talk about how they go about doing this. How should one think about the opportunities that are available to them?
Sure. I think Jodie said it nicely. We talk about the market really as physical first. So let's talk about the physical market, whether it's gold, silver. Right now you're seeing the platinum, palladium market start to percolate back up. Uranium, copper, all the physical assets first is a core allocation. And particularly when you think about gold, gold is really a wonderful diversifier in a portfolio. It's a proven track record. People know what it is. And it has a history of kind of zigging when the markets zag. So when people are looking at commodities for the first time, you really got to ask them why. And the question is, are you looking to diversify your portfolio and maybe go risk off? Or you look to be more opportunistic and go risk on? And if you're looking for the risk on side, going beyond the physical and going into the miners themselves can be much more opportunistic. They can still be volatile. They are companies. Things go bump in the night, risk of nationalization, all kinds of things can happen. But when the margins and the dividend yields and the enterprise values over EBITDA, all these things start rolling together. Right now, we also like the miners. So for those that want to be tactical and opportunistic, I would say look at the miners, but start with the physical markets first and then graduate your way into the underlying mining stocks second.
Don, how does all the movement in the dollar this year impact real assets?
Yeah, we're accustomed to a reliable negative correlation between the US dollar and metal prices. So, strong dollar should put pressure on prices as denominated in other currencies. And a weak dollar, as now, should boost prices. But that correlation was broken for a few years as gold prices strengthened and the US dollar strengthened simultaneously. Now we're seeing the dollar weaken, gold strengthen to record highs, which is closer to the natural correlation. In other metals like steel, a weaker US dollar should disincentivize imports, which is a key policy goal. We've seen the US has imported about 20-25% of its steel for many years, and excess capacity should be able to absorb more production. In aluminum, on the other hand, which has a 50% tariff on it, means that US metal buyers now face some of the highest costs in the world with no significant amount of domestic capacity to substitute in an environment with a weaker US dollar.
Jodie, how should investors think about the evolving role of the US dollar, particularly given the fact that central banks are now diversifying their reserves? There's alternative currencies, settlement systems. What's going on there?
Yeah, the US dollar is still the world's reserve currency, but the ground is shifting. The central bank's dollar share has declined from 72% in 2000 down to below 58% in 2025. Meanwhile, gold's share has a reserve is rising, and the yuan is quietly gaining ground, especially in Asia too. So for investors, this translates to more currency risk, more volatility across global portfolios, and we're seeing the early adoption of alternative settlement systems and more bilateral trade outside the dollar. Practically, this means more attention to active currency management as well as more weight on non-dollar assets and stores of value like gold, Bitcoin, and broad commodities, plus a serious look at foreign equities and bonds in structurally sound economies.
Ed, given that central banks are accumulating more gold, what price implications does this have?
Yeah, it's been interesting. Central banks the last 3 years, so in 22, 23, and 24, they were buying over 1,000 metric tons a year. And just to put that in perspective, that's at 3,400 plus an ounce, it's over 125 billion a year of gold they're actually accumulating and buying on an annualized basis. We're seeing the same thing this year as well, and part of it is an unofficial way to back their currencies, both here and abroad. Even though that's not a direct policy, as they continue to print more money to back that and other assets on the balance sheet, gold is serving as that role. You're also seeing what Jodie said is there's different ways to settle now. You're seeing gold be used to settle oil trades and so forth in other parts of the world. And it's actually serving the role that it's always been, which is an alternative currency to the US dollar. But central banks are really driving a lot of this. And as we take on more debt as well, here and abroad, gold's also being used to offset some of that and have a real asset on their balance sheets. So that kind of balancing the ledger mentality with central banks and balancing the ledger, that mentality with the US dollar and other currencies as well, gold is stepping in and filling that role. And I think cryptos are going to start doing that at some point down the road as well. And we're seeing gold and actually cryptos actually work together in many cases. And be happy to talk about that also, because that's a kind of a phenomenon that's really started to change over the last 3 to 4 years as people look at both as productive assets.
Well, how about you extend upon that?
Sure. So, if you think about cryptocurrency, if anyone remembers about 7-8 years ago, there was a great ad and it was showing people walking around dragging their bags of gold and silver and so forth. And they called Bitcoin gold, which I kind of get, but they also referred to Ethereum as silver, which made no sense because silver really gets consumed where gold really gets stored. So you really can't consume a digital currency, right? So, but what that did was it woke the world up to think about assets outside of traditional stocks and bonds. And that was probably the best thing to happen to the gold trade, is that it sort of legitimized it once again and said, you know what, it makes sense to have a portion of your assets outside the traditional banking system. It makes sense to have a portion of your assets outside of stocks and just bonds, the old 60-40 model. And that really reinvigorated the gold story in a lot of ways. And we deal with a lot of private families, endowments, universities, trusts, and so forth. And when we're talking to families, in many cases, it's the grandparents that talk about gold. The parents kind of accept it, and the kids roll their eyes. That's changed. A lot of these people now are looking at it and say, hey, we want to look at risk-on allocations like cryptocurrencies because we think the cryptocurrency market is going to grow, and Bitcoin being the primary one. But we want to offset some of that with something like gold. And so we're seeing more and more institutions, more and more investors look at both cryptos. And I say just cryptos because not just Bitcoin, but Bitcoin is a de facto cryptocurrency out there. That with gold, they're working together, which I think is really fascinating to watch, where 7, 8 years ago, they were kind of mortal enemies. So that's changed a lot in the last, half a decade or so.
And doesn't that have a lot to do with the regulatory environment as well, given, we all watched the downfall of massive crypto exchanges, and now it seems to be growing up, if you will.
Yeah, it is growing up. And, there's some great, kind of cartoons and memes out there about gold versus cryptos. But gold has the benefit of thousands of years. Crypto's still a new thing, and people can't physically hold crypto. So you do have to think of it a different way, but they do function in a lot of ways in a very similar way. The biggest thing is, I will debate kind of, is crypto really a store of value? Most investors aren't buying it because they sold their business and now they want to really stockpile their wealth. They're buying it because they think it's going to 200 or 300,000 a coin, right? Where you're not seeing central banks, buying cryptos and so forth. That may evolve over time, or we may digitize more things over time, like the US dollar or gold or whatever the case may be. But the central banks, the store of value still really is held in the real asset, precious metal side of the equation. I think crypto is more of a risk-on, frankly, type of allocation, where physical gold is more of a risk-off diversification allocation.
And price plays a huge role in all of this. You mentioned that before. So how have investors missed the big move for gold and silver?
Yeah, the big move thing, that's something I always like to sit people down and say, people thought they missed it when gold was at 1,800. And then it broke through 2,000. Oh, I missed the move. 2,500, I missed the move. 3,000, I missed the move. Gold's a relative asset. Gold, it's relative to what the US dollar is doing, or other currencies are doing. It's relative to the S&P. It's relative to the value of bonds. It doesn't have a dividend yield. It doesn't produce income. So it's a store of value. It's a relative asset to the rest of the market, the rest of the economy. I was actually talking to an investor a couple months ago, and he had a concept that I thought was really interesting. He said, the price of gold doesn't really change. It's everything around gold changes. And so it's really, gold is like the hub of an economy. It's sort of the regulator. And as the market goes up, as inflation goes up, so too does gold, and it keeps up with inflation. I think that's why people call it a store of value. So, gold is interesting in that regard. This idea that you've missed the trade or you're getting the pricing right, I think is the wrong way to think about it. And it's really a diversification tool in a portfolio, or a store of value tool in your portfolio. So the further you go down your risk spectrum, the more you want to have things like gold and alternative assets. The more conservative you are, you probably don't need as much of it. So it really depends on the rest of your portfolio. And again, it goes back to what I said. It's more of a relative asset to the core of your portfolio.
Jodie, let's turn back to you. Given the rising geopolitical fragmentation that we're going through right now, and you also see concerns about fiat debasement at the moment, globally, frankly. So what role, if any, should Bitcoin or cryptocurrency in general, digital assets, play alongside traditional stores of value like gold, like silver, like things you can touch?
Yeah, the thesis of Bitcoin as digital gold is arguable, like Ed said, but it's also, I think, never been stronger, because like gold, Bitcoin has a capped supply and operates outside of the conventional financial systems. So in an era where fiat currencies are being devalued and central bank trust is under pressure, Bitcoin offers a new possible form of monetary insurance. And the adoption is now really institutional. We've seen, by now, combined US spot Bitcoin ETFs topped $70 billion. And that's with big names in the institution space, like Wisconsin's pension fund just disclosed direct holdings. That was a first for a large public plan. And the asset, though, is still volatile, very much like risk on, risk off, So there's that component of it. It may be a good diversifier sometimes, but it is still very much driven by the risk sentiment. And in addition, the regulatory frameworks are still evolving. So for most portfolios, I think Bitcoin is not a replacement for gold. You may see it alongside gold, and it potentially serves for an asymmetric hedge against the monetary disruption and policy error But for many professionals, an allocation, I think somewhere in the 1 to 3% range, maybe high on the 5% range, can complement gold and other commodities and other real assets. And it can add some optionality for scenarios where fiat confidence breaks down. And, we see a little bit the comparison that you mentioned with silver and ether. One thing about ether too that can be used alongside Bitcoin, like silver is used alongside gold sometimes, is that ether is consumed for every computational step on Ethereum. So in a way, as you might use silver as an industrial metal, you might use ether as a building component, a commodity feeding into the digital infrastructure in Ethereum.
Oh, that's an interesting way to think about it. And I'm going to turn back to you. Would you agree with Jodie that Bitcoin should be alongside gold, or do you think that Bitcoin is slowly replacing gold as a store value?
Yeah, I don't think it's a replacement. We have a lot of institutional managers now that are using it as another piece of the puzzle. Let's say they have a 3 to 5% allocation of gold, and that's kind of the risk-off side of the equation. And then on the risk-on assets, I mean, you look at the way cryptos move in general, they're still kind of mimicking the NASDAQ a little more. It's more of a tech reflection than it is a currency reflection that's happening in the market. We want it to be a currency reflection, and it may at some point mature into that, but I don't think it's replacing it. In fact, I do think they serve different purposes in a portfolio. And as I talked about a little earlier, is we're seeing more and more investors. We have a couple partnerships out there where they're actually having in the same portfolio as part of their currency or diversification or opportunistic or other types of asset, alternative asset basket. They have crypto, they have gold, they have real estate, they have different things in there. And so you see big universities, endowments, most of their portfolio is in alternative strategies. You don't see the traditional stocks in there. Some of the big pensions might still be, 60-40, a lot of income stream from bonds and so forth. So it depends on what product or what firm or company we're talking about. But you see about a lot of these big institutions and big universities, they're heavily weighted to the alternative side of the equation. And you see that more and more, both gold and a crypto is in the same portfolio. So I don't see a replacement there. I really see them working together. And I see them doing different things in the portfolio over time.
Ed, how do rising geopolitical tensions along with global debt levels, which are not great, how do these affect kind of the long-term investment case for gold and for silver?
Sure. Well, the debt level, I think, goes back to what central banks are doing. As they take on more debt, they need something to back that. Unless you're the United States where you have tanks and planes and say, no, we want our money back, you need something. And gold is serving that role. And you're seeing central banks all around the world continuing to buy more gold. So that's what's happening, I think, on the debt side. On the geopolitical side, it's sort of a sad statement, but unfortunately a true one. We have geopolitical occurrences on a daily basis now. So this kind of idea that something is going to go bump in the night and gold's going to skyrocket has become more and more diluted. And when it does happen, it affects the price of gold, but it has very little to do over a full cycle with the value of gold. And when you think about why you're investing in it, you're not investing in it for the price movements unless you're trying to trade it. And good luck to you if you're doing that. It's a great way to lose a lot of money really fast. But if you're buying it as a tool in your portfolio, geopolitics don't really change the value that much. It might move the volatility around, the price around, but it's not really changing the long-term value, the why behind why you're investing in gold. So geopolitics are fun to talk about. It does create disruptions in the market. But when you look at what's moved gold over time and what's created true value over time, it's really other things like balance sheet quality, business quality, inflation, deflation, different types of markets moving here and abroad. It's really much bigger than something happening overnight in a geopolitical standpoint.
Go ahead, Jodie.
I was just going to add to that and say that while maybe on a day-to-day basis, the geopolitical backdrop doesn't drive really any asset, specifically like gold, but what it does is it does move not only investors, but the central banks towards accumulating gold. And I just pulled a couple of numbers. According to the IMF, in 2024, the global debt hit a record, 315 trillion. That's over 330% of the world's GDP. And The problem is that the central banks are really boxed in. They can't normalize rates without fiscal stress. So they're creating this environment of financial repression and persistent negative real yields, which, if you look at history, is extremely bullish for gold. So they are linked through the global debt issuance and the way that central banks are trying to manage risk. And if you look at how much gold the central banks have snapped up, the World Gold Council has said in 23 and 24 both that central banks took 1,000 metric tons of gold in both years, and that's the fastest pace on record. So, for example, when the Ukraine war escalated, countries like China and India materially increased their reserves to diversify away from the dollar exposure and also act as a hedge against the U.S. sanctions risk. One more thing about gold and the central banks is that I've looked at gold's relationship to a number of factors for a long time, whether it be the stock market, the dollar, which the dollar it is related to because it's priced in dollars, but there's really no one factor that you can pin to predict the price of gold, but the central bank buying and selling, and they always get it wrong.
Yeah.
So
that's important.
There's something actually, not that they know that not everybody else knows, but they're slow.
Right.
They're slower than the investors.
Yeah, they're turning a big boat around.
They're getting it wrong. So if you want to look at central bank buying and selling, maybe take the contrarian view and go the other way.
I want to turn back to silver for a second. Let's talk about silver, because this is interesting. You know, there's this growing industrial demand for silver. You have EVs, you have solar, you have AI infrastructure. So how should investors kind of balance silver's dual role as both a precious metal and an industrial metal?
That's a good question, because silver has an interesting role in a portfolio because it does sit at the intersection of the monetary hedge with the industrial engine. So on the monetary side, silver aligns with gold as a store of value in uncertain times, but the industrial demand is booming. So according to the Silver Institute in 2024, silver's industrial usage hit a record 654 million ounces, with over 200 million ounces going to solar panel production alone. That's a nearly 30% jump from pre-pandemic levels. So to put that into perspective, for the first time, solar manufacturers are actually absorbing more silver than what's seen in global coin and bar demand combined. So what that means for investors is that silver is no longer just trading as a safe haven, but it's riding secular tailwinds from the electrification, renewables, and advanced computing. And that means that the price can spike on supply shocks or when manufacturers restock, but it can also see volatility if industrial activity slows. So for the allocation, the best way to balance that duality is to own both physical silver, maybe through ETFs or bullions. You could consider a basket of miners. Miners you have to be a little bit careful with because they might be tagged as silver miners, but they might be mining any metal of the moment. So there's not direct relationship to silver. You could also use other instruments like futures. But the silver can offer some more upside in periods of demand expansion. So the miners, they carry operational risk and political risks. They make decisions for shareholder values, which can be different than anything that has to do with the price of silver. So you get a little bit lower correlations, probably like in the 0.6 range rather than the direct exposure. But the net result is that if you hold some sort of mix, silver provides gold-like insurance with a built-in call option on the green energy and tech growth story.
Mm-hmm. And let's turn to copper for a second.
Sure.
We haven't spoken about this one. Rising demand, they're actually surging. There's this electrification that's going on. We need copper for that. There's also this tight physical supply.
Right.
It's a perfect storm. So how should investors evaluate physical copper exposure versus the miners, as Jodie brought up, and how do you balance this in one's portfolio?
Sure. Copper is sort of one of my favorite stories because everything we're doing right now, you can't do without copper, right? You can create electricity through wind. You can debate if that's effective or not. Solar, you can do, hydro, nuclear, we can talk about that. Oil and gas, coal. There's a lot of ways to create energy, but there's not a lot of ways to move energy, right? So you've got silver, which is the best conductor, too expensive. You got tin that overheats and catches on fire, so you can't really use it. So really, copper's it. And forgetting everything that we've talked about with AI and everything else, just the basic block and tackle of revitalizing and maintaining our US grid, not to mention what's happening in India and China and electrification of the world. I mean, electricity is life. You can't do anything without it. I mean, case in point, everything we have here needs electricity. And so we need more copper. And all the copper ever mined in the world, we need to double that in the next 2 or 3 decades to try to even maintain a semblance of supply-demand balance. So we think that imbalance is going to continue. All the easy copper has been largely had. Some of the largest copper mines out there, they're running out our runway. New discoveries are limited. It takes a good decade plus to get a new copper mine up and running from point of discovery to point of extraction and refinement. So we're in an issue here, and prices, in our view, over multiple market cycles need to continue to go up to benefit those and say, hey, I'm going to get paid to pull this out of the ground, refine it, and sell it. And unless we come up with some wild technology we don't know about yet, there's no other way to move electricity around. So this is going to be here for a long time. And I think one of the things that Wall Street got wrong early, and I think are getting right now, is they always historically have thought of copper as a bellwether of the strength or weakness of the economy. And in some degree, that's still true. China consumes over 50% of all the global copper out there today. And if China slows, will the price of copper slow? Kind of goes back to my geopolitical thing. Yeah, the price may slow, but the long-term value is going higher. And so that's something we really believe in right now, is that the price may fluctuate a little bit based on the strength and weakness of the economy. But regardless if the economy is growing or not, we need more of this period, whether it's to maintain what we currently have or to add on to what we need a lot more of it, and it's getting harder to find. So we like the value of it a lot.
This is just sidebar on copper. Are there any sort of artificial ways to create copper, or is it like oil?
Yeah, not really. There are some, but to do it in the size and scale and volume, and the problem with copper is, like I said with tin, you're sort of dancing with the devil here. You might save a few bucks, but you may burn down your building. So it's one of those things that, listen, if copper goes from 10,000, to 20,000 a ton or a pound, and if these prices start to go higher, in the big picture, it's still not that big of a deal to the overall production of what we need to create there. So to try to cut corners and create a synthetic way to move electricity, we would applaud it because we need it anyway. We need both. It's kind of like crypto and gold. If we had a new technology tomorrow, I really wouldn't change the narrative for copper much over the next, probably 2 or 3 decades. These things take a long time. So if there is stuff out there, the extent it can be used in large scale projects, we're a long way off from that.
Makes sense. Don, we miss you. Is there anything that you'd like to add to, the growing industrial demand for silver or rising copper prices? What are your thoughts?
Sure. One of the things that we're always conscious of, because we're looking at debt, we're looking at downside risk for these mining companies, is price volatility. So in as much as copper does have a great story, it's S&P Global research that found that we do need to be doubling the amount of copper potentially in the next few decades to meet our goals for electrification, which seems improbable given how companies are spending to explore. I think Ed's bang on in terms of technological changes. And the technological changes we see for copper, well, they've kind of already occurred. So SXEW is a processing technology that basically allowed for a lot of processing of low-grade copper, but that's 30, 40 years old now. Nickel's had that kind of technological breakthrough with HPAL in Indonesia, so you have this burst in supply that seems improbable in copper. Nevertheless, we still keep an eye on mining costs, which is probably one of the bigger headwinds that companies face right now, and is being able to be profitable as they find and extract and develop new mines.
Ed, has the move in copper already happened given the potential global economic slowdown that everyone keeps talking about and will inevitably happen at some point?
Yeah, it's interesting. I think the move in copper, I'm going to echo sort of what I said about the move in gold. I don't want to be callous about the price of things, but if I've been in this industry for about 30 years now, and I can tell you that, maybe I have 30 different experiences, or maybe I have 4 or 5 experiences in those 30 years. But what I know is if there's a supply-demand imbalance, and if there's more demand or more consumption than what we can deliver to the market, the price typically goes higher. And there'll be things that come in and create that volatility. But again, I caution people to focus on the price. And I encourage people to focus on not what something is valued at today, but what is it going to be valued at tomorrow, as far as what is it doing? Do we really need it? Can we get away with not using it? And the answer is no in copper. So the reality is, I wouldn't look at this and say, hey, I missed this current price. Because 10 years ago it was a little over 2,000. Hey, I missed it. Now it's over 10, and it's climbing. So again, if you can widen your lens when looking at commodities, and you really need to do that. It's not like a company that's rolling out with a new iPhone or a new product or a new car. This is a long multi-market cycle, multi-generational type of allocation. And so I encourage people to take a wider lens when they're looking at commodities in general, but that's very true as you're thinking about copper. If the economy slows, the price is going to sell off a little bit, and that's a knee-jerk reaction. But the long-term supply-demand imbalance is a real thing. I don't care how much recycling we pump into this market, it's not going to meet that demand. So we see that price escalating over time, with the course volatility along the way. So I encourage people not to get hung up on the current price of where it is today, and think long-term, what's the value of this, and what is it needed for, and we need a lot more of it.
And Don, how does the macro outlook and heightened economic uncertainty impact the metals and mining space as a whole?
Sure. There's always going to be some economic sentiment that drives metal prices. So we got to be conscious of an overreaction to economic news, for example. On the upside, we've seen basically a steady to softer economy globally has been generally favorable for metal prices. So things are in good shape there. If there's a lot of downside risk on the economy, to Ed's point, there are places where there might be some downside risk in metal prices, but the costs of production are rising pretty steadily and I guess pretty relentlessly, so that the price downside for metals appears to be a lot lower than it has been in other cycles, because we just don't have the prospects for a bunch of low-cost oversupply to hit the market. So yeah, expect the economy to kind of give us some sentiment indicators, but you got to look sort of metal by metal, supply-demand balances and cost profiles to understand what the downside is. Copper, probably not a lot of downside. Nickel, on the other hand, may be a lot of downside, given that we are seeing new supplies coming onto the market.
And does Sprott offer other types of investments outside of precious metals? And if so, are there any critical materials that Sprott likes at the moment?
Yeah, we talked about copper. Obviously, if it's not clear yet, I love copper.
Yeah.
I think it's going to be something that's going to continue to define not just us as a firm, but us as a U.S. economy over time. But we also love uranium. I mean, uranium is one of these things that when you think about nuclear power and you think about 24/7 baseload energy needs, you think about data centers and AI and hospitals and military bases, they don't have the luxury for the power to go out for a second, right? So if you look at California was having rolling brownouts. One of the things they did was they decided to extend the operating license of Diablo Canyon, which is one of the last nuclear power plants out there in operation. And this is before we even talk about expansion. So just the existing plants that we have here and abroad, we don't have enough uranium to actually feedstock these reactors. Then you've got new reactors coming online. In areas like in China, you have over 2-3 dozen new reactors coming online in the next decade. You also have coal plants still coming online. And this goes back to what I said earlier. This takes decades. This is probably a lifetime kind of allocation. This doesn't happen overnight, right? So these things take a long time. You got new nuclear reactors coming online. You still got new coal plants coming online. So and those are the two opposite ends of the spectrum. So we really like uranium. We like the storage metals, the battery metals, so the nickels, the lithiums, and so forth. I think those are a little more interesting because You're going to get wild volatility there. 5 years ago, we were all told we were going to be driving 100% electric cars. That's not happening anytime soon. You're not seeing big trucks out there being electrified. There's nowhere to charge them. They're too heavy. They can't cross the bridges we have in our current infrastructure. That's not happening anytime soon. But those metals are going to go up and down a lot. And so that's kind of more on that risk on spectrum of the edge. So if I'm sitting on the other side of the table as an investor or as an advisor, I would say gold is my risk off allocation from a diversification standpoint. I would say silver is kind of my bridge metal. And what I mean by that is it's moving out of that currency, gold shadow type asset, precious metals asset, and really moving into the critical materials side of the equation with reflective technology for solar and cameras and so forth. And then you have your copper and your uranium. So those would be the four really disciplines I'd be looking at now as an investor. And again, gold is my risk off. Silver is kind of my balance from the precious to the critical material, and then copper and uranium. This 24/7 base load need is a real need. And wind and solar are wonderful. Hydro, that's very specific to region. You don't have luxury to do hydro everywhere. There's natural gas. Natural gas is growing. But this idea that it's a replacement, we even talked about the energy transition. It's really not a transition at all. It's really an addition. We need everything, right? So we still need coal plants. We need more nuclear power plants. And so for us, copper, silver, gold, uranium. Those are the four we really like.
I have to ask because it's just so in the zeitgeist right now. Cobalt.
Yeah.
What are your thoughts on that?
Yeah, cobalt's interesting. We have a fund that it gives you lithium, nickel, cobalt, rare earths. It has all that in there. As an investor at our level at 40 billion, part of the problem is that scale, right? How much are you going to get? And we're really big believers in owning the physical metal itself. So that's really what sets us apart. We're not really into the option strategies and paper contracts to get exposure to spot price. We want to actually own it. Cobalt's difficult to do that with in volume. So I think it's interesting. I think maybe looking at a couple companies could be interesting, but for us as a firm, it's pretty far down the pecking order as far as what metals we can manage and actually deliver value to our investors. The four I mentioned, there's volume out there, there's liquidity out there, there's an appetite out there, there's a huge demand for the four metals I talked about already with gold and silver and copper and uranium, but our critical materials as it relates to uranium. But those we can invest, those have scale, those our investors can participate in and profit from over multiple market cycles. Cobalt, you certainly can as well, but it's just the liquidity of it, the scale of it, it's going to be difficult to do at a large scale from a fund standpoint.
Makes sense. Jodie, how are real assets beyond metals and other commodities? You have things like energy and agriculture, infrastructure, real estate, arguably the tips. So how are they positioned to perform in a potential environment of persistent inflation that we have seen for some time now and financial repression?
Yeah, that's a great question because as we're coming out of this period of inflation and suppressed real rates have forced allocators to rethink that 60-40 mix that they've used. They look for other opportunities where they can generate alpha and diversification. Global infrastructure funds have outperformed global equities by roughly 8% annually over the past couple of years. And as inflation protection and stable cash flows become more valuable, that has been a critical allocation. So infrastructure is one. Energy, both fossil and renewable, that's still a big spectrum there. That remains at the center because the U.S. pipeline contracts linked to the CPI have seen substantial repricings as natural gas demand has soared as well. On the agriculture front, we've seen a lot of supportive price pressure there from the volatility and climate change. Food security concerns more than ever. So, that's really positive for the investors in the agriculture space. We've seen the farmland REITs showing record rental escalations. So I think, and again, arguably tips on the inflation front, they're technically a financial instrument, but some do put them into a real assets bucket. They offer liquid inflation hedging. So For me, the key is to diversify, not only diversifying beyond the metals and going into the industrial metals, but across energy, agriculture, infrastructure, real estate, tips. And the beauty of this too is it's not just the diversification across those asset classes or sub-asset classes, but it's by the instrument type. So you can go direct, you can go through equity, fixed income, you can go through futures, derivatives markets, you can do private markets, private equity, private credit. So there's a huge pool to pick from in diversifying these real assets. And it is important to keep the mix and not just some separate allocation to gold, because depending on the different sources of inflation, that will drive the performance at different times and give you the more steady source of exposure for the purchasing power, generating income, and in order to keep your correlations, that diversification power with the inflation protection, especially in the stagflation or policy strained scenarios.
Makes sense. So, Ed, we know AI data centers, they're coming online fast and furious. You have grid modernization as well. So this is all driving long-term electricity demands and how that's going to evolve and play out. So how critical is nuclear power? You touched upon this before, but I'd like to expand. And by extension, uranium, as you mentioned. And are they going to be able to meet the base load energy needs? And are the markets fully pricing in this demand shift?
Well, the markets aren't pricing it in for sure. Because the short answer is no, we're not going to meet the demands. It's why we started to pump the brakes on everybody having electric cars. We don't have the infrastructure. We can't produce electricity. We can't charge them fast enough. We don't have enough battery metals to actually create the batteries needed to even do this. So no, these are all aspirational. I remember, early on it was by 2050 we're going to be completely electric. That sounds great. I don't have grandkids yet, and in fact, I'm not sure my kids are even pegged their significant other yet. But the reality is, it's probably not even my grandkids' lifetime. This is going to take, I keep hitting on this, but it's going to take so long for those things to happen. Again, these are multi-market cycle types of moves. But when you think about what's happening in nuclear in particular, and you think about the data centers and AI and stuff, I want to take a massive step backwards and talk about air conditioners in India. So about 5% of the Indian population currently have air conditioners. Air conditioning growth rates over there are running at about 35 to 40%. So we talk about data centers, AI, security, accessibility, all that stuff. We get outside the globe, some places don't even have electricity to have a single light bulb, or they're getting their first washing machine for the first time. And the demand on electricity on that is unending. It's huge. They don't have the infrastructure in place to even meet that need. They're already curtailing what the wattage could be of an air conditioner in India because they don't have electricity to support it. And that's changing rapidly. So it's fun to talk about data centers. It's fun to talk about AI, energy security. That's all very important. But that's for 1.5 to 2 billion of the population. The rest of the population, they're excited to have their first light bulb in their house. And so the electricity demand is really unending. And I just don't see an end in sight for that. And everybody should have a cool house in the summer, and everybody should have a light to read by at night, and that's really where the world's kind of going. And so I applaud the rest of the world kind of getting, more modernized, but the electricity demand for that is just, when you sit down and actually look at it and think about it, it's staggering. I don't know how we get there. And so nuclear is certainly part of that. It's clean, it's sustainable, it's safe, it's 24/7, it's base load. The technology of it, the security of it, all those things are at the forefront now. So, and then you talk about, we're not even into like small modular reactors and micro reactors and being able to create energy source at a particular factory or a data center, purely creating their own energy and consuming their own energy and being their own ecosystem. Those things will start to happen over time. And there'll be other energy sources out there, but nuclear is certainly one of those guiding lights that's going to get us down that path faster, safer, and more affordable than some other sources.
So given that, what is the base case for uranium?
Yeah, we need a lot more of it. Now there's different, there's fusion versus fission. There's different technologies that are kind of coming online. Uranium sold off a lot when about a decade ago, MIT and Harvard both came out with white papers, research papers on different technologies on ways to operate a nuclear reactor. We're decades away from that. So it goes back to the whole copper story. These things take multiple decades to bring that technology online. So right now, uranium's less than 10%. It's actually closer to 5% of the operating budget of running an overall reactor. So even if uranium doubled in price, you still need it. It's not going to really change the dynamics that much of the profitability or the functionality of that reactor. So it's still a relatively small part of the overall construction, maintenance, and running of a reactor. So for us, we don't really see a replacement happening anytime soon from a technological standpoint. From a critical material standpoint, we see uranium as a de facto fuel source to run these reactors, whether you're small modular reactors, which is kind of cool because those actually can use recycled or spent fuel rods from the larger reactors. So things are happening to elongate the usefulness of a fuel rod, and they can go from one unit to another, which is pretty cool also. But that's probably a half a decade to a decade out before you start seeing modular reactors really become implemented at the commercial level. They're certainly been implemented at the military level. I mean, you think about subs and stuff that can be underwater for months on end. Nuclear, that's all nuclear. You know, they're running those reactors on a submarine underwater for months on end, not surfacing. That's now starting to come to land in these smaller, more micro reactors, but still, that's not really at the commercial level yet. We're getting there, but we're probably a decade out before that really becomes a commercially viable thing as well.
And I just want to make sure I heard this correctly. 5% is about the spending on uranium for a reactor.
For a reactor, yeah, because
so you don't need that much.
You don't, and you think about gas in a car. Yeah, fuel cost is important. I mean, if anyone has their yard mowed in the last decade, you see a fuel surcharge on your bill, right? So fuel is certainly an important part of it, but when you think of everything else that goes into creating that electricity, just the people alone, the infrastructure, the security, all those things, there's a lot more cost out there. So it's back to the world of relative. It's expensive, but relative to the overall cost of operating a reactor, it's a really relatively small piece of the pie.
It's very interesting. I see why it's good for talking points with investors.
Yes, yes.
Could talk about it for ages. Jodie, let's talk about how AI is reshaping industries and capital flows as a result. So what are the second order investment implications across sectors, resources, infrastructure, beyond just the tech names driving those headlines?
The AI is changing not just how companies work, but how the capital flows and where it's flowing. So from hardware and chips to raw materials to infrastructure. We've heard utility executives now attributing up to 15% of their projected power load growth to data centers and digital infrastructure. And that's driven directly by AI. There's a big question of whether the infrastructure will hold or whether it will become obsolete in light of how quickly AI is changing. But you've seen like Microsoft and Google have signed multi-billion-dollar deals with utilities just for power and grid connections. That's something that was unheard of 5 years ago. So the opportunities here are beyond the obvious tech names. Think about companies building the semiconductors, manufacturers of specialty alloys, the utilities, grid operators, and infrastructure funds. Real estate, especially anything tied to data centers or logistics, are being re-rated. So even labor markets we've seen shifting with productivity booms and displacement, opening opportunities in training and cybersecurity. But again, through history, as we've seen new technologies, there's always question of whether that technology changes faster so that the infrastructure built becomes obsolete. We've seen this all the way back. I think early there was an instance in Chicago where they were creating new waterways for commodity trade, and it took them so long that the railway system caught up and the canals became obsolete. And that was for commodity transport and goods transport in the old days. Now this is data transport. So there's a big question as to whether this will hold or not.
It's interesting. I think a lot's going to change in the next 18 months, let alone 18 years. But actually, Don, let's turn to you now. Do you think that AI could impact the metal and mining space? How do you see it impacting it?
For sure. I mean, we see exactly the same sort of important pulls on demand for AI and electrification. It really is remarkable when you have the U.S. proposing to onshore aluminum, which we colloquially call congealed electricity. About 30 or 40% of the production costs of aluminum is electricity. So if the idea that you could reshore that much metal into the U.S. Without having to go through this gauntlet of AI demand seems unlikely. We estimated that you'd need as much electricity to power New York City to reshore all the aluminum into the U.S. Alcoa has estimated something like 7 Hoover dams. So it kind of tracks at like $50 billion of electricity investments just to get that aluminum back into the U.S. And to think that those maybe 10,000 jobs are going to outcompete AI investments seems improbable. So we see a huge, conflict there in terms of the industrial policy, but the demand is unquestionable. Our utilities analysts say that the spending on new power plants is coming. Ed's right. Nuclear is good prospects, but it's still quite a ways away. Big investments still at least 5 years away before we start to see those materialize. But every other source, gas is a huge demand right now. So gas turbines are a huge demand factor in the industrial space. And then AI for mining. AI for mining actually has some good potential because we've had a really hard time finding incremental metal. So when we look at inflation, we look at tight supply chains, and we look at the availability of metal and where it comes from. It comes from more difficult places. It's getting more expensive to produce. AI has the potential to help us scan the globe and find new sources of lower cost metal. At the same time, like everything in AI, yet to be proven.
Ed, we've talked a lot about physical precious metals,
Sure.
but let's talk about the miners, specifically the individual mining stocks. How are they performing? What's going on there?
Yeah, until recently, the miners were really, I think punish is probably the right word, because of sins of their fathers, so to speak. The old days, the mine would start doing well, the company start becoming profitable, they'd issue more shares, they would dilute the value of the company, and they would continue, they would just do that cycle over and over again because it's such a huge consumer of cash and human capital. Well, this new wave since 2011, many of the CEOs have always been replaced, and the next wave of CEOs that have come in are thinking longer term, dialing up and dialing down production. Part of that is because of technology. Technology does allow you to dial up and dial down the production of a mine in a way that you couldn't in the past. Before, you had an on-off switch, that was it. So whether the gold was going down or going up, you were pulling out of the ground, didn't matter. Now you can kind of ebb and flow that in a way that you maybe couldn't, 2 or 3 decades ago. But the world kind of forgot about miners for a very long time. And when you look at what the metals have done versus what the miners have done, there's been a huge disconnect. Now, that's been a little different in the uranium miners and the copper miners. They're going up 2 or 3x relative to the underlying assets that they're mining. The gold miners are starting to play catch up with that as well. That gap is starting to close. And with the last year and a half, 2 years where gold's outperforming and silver's outperforming, the miners have now started to catch a bid. And that goes back to kind of people caring or not caring. It's the old value trap. You can have a great business, wildly profitable, phenomenal balance sheet in a really smart part of the market, but if people aren't buying the stock's not going to move, right? And so that was kind of what was happening with mining stocks in general. You're seeing institutions, you're seeing individual investors, you're seeing people start to move back into the space cautiously, and for right reasons, because people have lost a lot of money in the past in these mining stocks. But if you look at the long-term projection of where things are headed, we really can't get there without mines. Everything we do, I always say you have to dig a hole first before you can go up. And you have to pull things out of the ground to meet the needs of modern civilization. We just can't do it any other way. And so we think these mines look very attractive longer term. Their balance sheets are better than ever. They've got dividend yields higher than S&P 500 companies. Profit margins are stronger. They're lower levered. They have great balance sheets. We just need the rest of the investment world to kind of recognize that and start allocating capital to it. So the big question is it a value trap or a value trade? And we think it's starting to slowly graduate into a value trade or value allocation.
And Don, what are some of the headwinds and tailwinds for miners that you see moving forward?
Sure. Ed points to it. Corporate development has been a bugaboo in this industry for a couple of decades. So to the extent you had companies taking each other over, or even having large greenfield investments, didn't pay off in a return on capital, especially in the gold space. And that's where we're starting to see, okay, gold at record high prices is starting to turn into, attractive return for these companies. But basically finding these assets, developing them, processing the metal are increasingly difficult. So we're going into geologically more difficult places to be able to extract metals. We're also going to geographically more difficult places that don't have a mining history, for example. So all that speaks to how difficult it is for this industry. Those are the headwinds. The tailwinds are, these are strategically important assets. There's no doubt that a gold mine, coal mine, copper mine has some attractive use, especially in, call it, geopolitical stress scenario. The products are indispensable. The assets are unique. So with a good handle on costs, industry-leading companies should enjoy decades of profitability and market relevance because the demand is not going away.
Jodie, there's a lot of growing interest in private credit. We're seeing this across the board. So how can investors assess the trade-offs between, you have inflation sensitivity, you have liquidity, so many other variables, and return potential for these private credit backed by real assets?
I'm glad you asked this because private credit has truly exploded in the last couple of years, especially in the asset-backed strategies. In 2024 alone, over $200 billion flowed into these vehicles. That's a high not seen since the global financial crisis. And at their best, the real asset-backed private credits, like think loans on infrastructure, real estate, or equipment, those deliver stable income and floating rate protection and a margin of safety. So, what we see is that some real estate private credit funds have given a net IRR around 10% in the last 2 years with floating rates and zero defaults, passing inflation straight through to their investors. And what I would say is that major trade-off is liquidity. These are not vehicles that you can get in and out of every day. They're not daily liquid funds. So investors need to be comfortable with the lockups and the more complex due diligence required in investing for these. But the benefit for income-oriented clients and those looking to diversify away from the public markets are that these strategies offer both return enhancement and inflation resilience, provided that the allocation is matched to the client's time horizon and risk tolerances and liquidity needs.
Makes sense. Ed, finally, for investors looking to allocate one or more metals, how should one go about doing that?
Yeah, I think it goes back to whether you're an advisor or an investor, you need to do an x-ray of your portfolio first. And I say that because if you're in a lot of tech companies, maybe some crypto companies, and you're further out on that risk spectrum, I think the story has to start with precious metals, specifically gold. When you look at what gold's done in the last 2.5 decades since the dawn of kind of financial engineering, of really kind of dialing up and dialing down, QE, QE1, QE2, Operation Twist, all those things we've done to try to keep the parties, going. Gold has done really well as a ballast to the rest of your portfolio. It's been a wonderful, low-cost way to diversify a portfolio for the last 2.5 decades. So for that type of client or that type of investor, I would stick with gold as your diversifying tool. And so often people look at what gold is and like, well, it doesn't pay dividends, so I'm not going to invest in it. But focus on what it's done. And it's been a very effective tool in helping diversify a portfolio. Then for those that maybe are more on the old 60-40 or more risk-off part of their life cycle of their portfolio, and they want to add a little more torque, or the more opportunistic investor, then I think you step into things like critical materials, copper, uranium, and then you also step into more the equity side, the mining side of things, because they do have more volatility, but they also give you more torque. So in the perfect world, if the cost was flat, which that never happens, but if it were, and the price continues to go higher, that doubling effect of margin expansion is incredible in mining space. Now, the trick is do they have their costs under control? So you're going to get more volatility because of that. But then I think, as I mentioned earlier, physical first, equity second, graduate into that equity space. And then silver is kind of one of those assets that I think, or precious metals, is really interesting because it still kind of lives in the gold shadow. It's now outperforming gold year to date. It just kind of started to catch up. But what's unique about silver, what silver has going for, is it gets consumed. Where gold doesn't really get consumed, it gets stored and it gets used, but it never really disappears. Silver disappears over time. So supply-demand dynamics of silver are becoming more and more fascinating as it gets consumed more. So it goes back to what I said earlier. I mean, on the precious metal side, love gold. I think silver is really interesting because it has, the duality of both being a precious metal, but also a critical material, and then copper and uranium. Those are the four. And then again, if you're a newer investor to the space, start off with the physical market, look at it as a diversifying tool. As you get comfortable, think about graduating into the miners from an opportunistic standpoint to add more torque to your portfolio. I do want to add one other thing. You talked about private credit, private debt. We have this wonderful private lending suite or franchise. The only negative really is it's capacity constrained. There's only so many good projects out there you can lend money to. So it's about a $2 billion sort of franchise, as it were. And we're doing all sub $100 million loans. So we sort of live in a part of the world that the rest of the market doesn't really participate in. Banks aren't going to do sub $100 million loans to mining companies. And the big companies that loan to mining companies aren't going to mess with sub $100 million loans. So we have a really unique space there as well. So for the larger family offices, a more sophisticated investor, and I say sophisticated, I mean it in dollar values. If they have a $100 million, $200 million portfolio, then our private lending business could be also very interesting for them. But that's really on the back end. I'd say physical first, equity second, debt third. If you have that, that type of portfolio that you can diversify that far into. But for most investors, just owning some physical metal, I think is a great place to start.
Jodie, do you have any final thoughts on this subject?
What I would say is that I believe that real assets do have a place as part of the core strategic asset allocation. It's not just 60% stocks, 40% bonds. I think that the diversification, the inflation protection, all of the variety of assets that go into real assets make it a really solid choice for investors over the long term. And tactically, there may be opportunities to invest in certain spots of it, but I do believe that real assets plays a role.
Don, I'll ask you the same question. Any final thoughts?
Sure. If we are talking about bonds, the credit quality of the mining and metals sector has basically improved for a decade. These are unique assets, and the bonds are backed by some scarce assets that should be profitable for a long time to come. So pretty good makeup for the sector from a credit perspective.
All of you, thank you so much for your time and your considerable insight. We really appreciate having you in studio. And thank you for watching this Real Assets Masterclass. I was joined by Ed Coyne, Senior Managing Partner at Sprott, Jodie Gunzberg, Managing Partner at InFi Strategies, and Don Marleau, Metals and Mining Managing Director at S&P Global Ratings. I'm Erin Real with Asset TV.